what we try to tell investors is that as bad as it feels, and it does feel pretty bad with oil prices being so low, the cure for lower oil prices is lower oil prices. So the current price crash that we're in, it's absolutely the positive necessary reset that the sector needs in order to bring long-term investors back. And so the E&P industry, it's been fragmented. And so eliminating these inefficient, uneconomic barrels has always been part of the self-help story. And so the price crash, it just accelerated this. And that creates a lot of interesting opportunities on the stock side. We think that there's going to be more volatility in the future and not less. And so that tells us we should stick to the high quality names. We want the names that can weather the storm. And so for us, that means we want, for example, very strong fortress balance sheets. And on our coverage list, that would be EOG and Pioneer, both of which have less than 1x leverage, even on strip pricing. And we see over 65% upside to our price targets on those. Secondly, we would probably want some big favorable hedge books to protect those cash flows. And for us, that would be Concho Resources and Hess. So Concho has over 130,000 barrels a day hedged at 57 WTI this year, which is amazing. And Hess has over 80% of their oil production hedged at 55. So protecting those cash flows. And then I would say also what's really important for us.
Let me, Jeanine, let me jump in on that point just for a second here, because it is, 5:17 in the morning. So when we're talking about a hedge book, what you're talking about is companies, they go out, not all, but they go out in the market to banks who then syndicate that out, and they basically make an agreement to sell oil at a certain price. If it falls, if it goes up, they're on the hook. So you're saying that Hess, which is well known to our investors by their CEO, John Hess, as well as Concho, they have the right to sell oil at nearly $60 a barrel, even as the price is down at $20 a barrel.
Exactly. And to us, this really speaks to management foresight and planning. And it all also depends on the kind of hedges that they have. So if you have, for example, price swaps, then you're guaranteed to lock in that price. If you have other certain hedges like collars, the price can move around. But for Concho and Hess, they have these swaps that absolutely lock in that WTI price at 50 to 57.
Okay, who else from a balance sheet perspective? You mentioned EOG and Pioneer. You obviously talked about Concho and Hess. Are there any other potential companies whose balance sheet, cash levels, net debt to EBITDA, whatever it may be, are strong enough to withstand 3, 6, maybe even 9 months more of extreme volatility and potentially extremely low prices?
Yeah, we've got a few of those. In addition to EOG and Pioneer that you mentioned, we'd also cite Concho as having a very strong balance sheet. ConocoPhillips also has a very strong balance sheet. They had the most cash as of the year-end 19 on any of our E&P coverage lists, which was about $8 billion. So that $8 billion that they have in cash and equivalents, that's going to go a long way in terms of weathering the storm and being an arsenal in case they need it if oil prices continue to stay low.
What about companies to just avoid at all costs, Jeanine? Is it everybody else?
We have a few that we think are going to be particularly challenged. In a low oil environment, certainly the more highly levered names are going to be a bit more challenged, as well as we're really looking carefully at debt maturity schedules. So any companies that have meaningful debt maturities in 2021, that could be an issue depending on where oil prices are and where the markets are. So on our coverage list in particular, Occidental as well as Ovintiv are two companies that have above average leverage and then near-term debt maturities due in 2021.